In this episode, we were discussing a very common question asked by newly set up SMSFs when they first lodge their tax return. When the SMSF receives their first tax bill, the question comes, we never received this tax payable amount in our industry super fund, so why we have to pay the tax in a self-managed super fund? So let's explore into this and understand how the tax works in a superannuation or super funds, specifically how it actually works in a SMSF or self-managed super fund. Under the Australian tax law, the super funds pay 15% tax on all of their income. The income for super fund is your employee contributions, your personal deductible contributions, any income received from investments like rental, dividends, interest income. Take away all the expenses. And super fund pays 15% tax on the net earnings of the super fund. Now, when the fund is an industry super fund, your employer pays your super guarantee into that industry super fund. They take the 15% tax out of that, deduct your insurance premium or any admin cost, and credit your account with the investment earnings of your balance after adjusting the tax in that earnings. So the balance of your member balance of your industry super fund shows the net balance after taking it out all the interest. It's the trustee of the industry super fund who pays the tax to the ATO on your behalf from your balance. Whereas SMSF works differently. In SMSF is like a business where actually you are the trustees of your SMSF and you got the full responsibility there, including paying all the expenses, which includes the tax as well. So in an SMSF, your employers pays your super guarantee into your SMSF bank account. All the income from your investments like the rent, the dividends, the capital gains and interest get deposited in the same SMSF bank account, and you as a trustee of the SMSF pays all the expenses like accounting fee, audit fee, rental expenses and any other to those people from the same bank account. When at end of the financial year, your SMSF accountant prepares the tax return for your SMSF, they calculate the net income of the SMSF, which means they take into account your contributions, your employer contributions, all the investment incomes like rental, interest and dividends, and take away all the SMSF expenses that SMSF is eligible to claim. For example, rental expenses, accounting fee, auditing fee, interest, and so on. And whatever the balance is left, there is a 15% tax payable on that balance. Plus, ATO charges $259 for the ATO supervisory levy. That's what you need to, or your SMSF need to pay. Now, because this tax was not paid on regular basis, you have to pay that end of the financial year. So just assume this works very similar to your PAYGs or your pay slip income, where your employer takes the tax out of your pay and pay you the balance of that one. So say if your weekly income is $1,000, your employer may take the $300 out of that and only pays you the $700. This $300 is paid to the ATO. In industry fund, it works very similar. So your employer contribute $1,000 to your super fund. Your super fund will take 15% out of that, $150, pay that to the ATO, and your account is only credited with the 1,000 minus 150. Whereas in your SMSF, it's a 1,000 that's going into bank account, sits there or get invested. Once the tax return is prepared, that's when it's calculated how much tax to pay on the net income of the SMSF, and you pay that tax to the ATO at that point in time. So the question is not why SMSF has to pay tax or an industry fund not, and who pays and who not. The question is, when the tax is payable. So with the industry or the retail funds, the tax is payable when actually income is earned or income is deposited into your account, whereas with the SMSF, the tax is paid at the end of the financial year when the SMSF accountant is calculating the tax payable amount. Now the next question comes is, once the tax return is lodged and you have paid the tax, you would receive a PAYG installment payments, and clients just comes and says, why I'm getting this amount to pay, whereas I've already paid the tax. Now how it works is, when you lodge your first tax return and you pay this tax, or you got this tax payable to the ATO for the SMSF, ATO calculates how much tax they estimate your SMSF has to pay for the next financial year. Take this an example. I have an SMSF, and for 2025 financial year, when I lodged my tax return, I've got a payable of $2,000. Now, ATO will assume that you will have to pay $2,000 for 2026 financial year as well. They do some of their calculations and they come up with a figure how much you have to pay quarterly. Most of the time, it's a tax with some factor on that one divided by 4. So say, for example, it comes to $500. So every quarter, ATO will send you a bill or PAYG installment for $500, which your SMSF pay every quarter. When your SMSF accountant will do the tax return for 2026 financial years, they will deduct this $500 paid quarterly from that liability, which means that if the tax payable for 2026 financial year is only $1,500, you have paid the 500 times 4, 2,000, your SMSF will get 500 refund. Or if the SMSF has $3,000 to pay, you have paid 2,000, you will only pay $1,000. So that's how the PAYGs works, or PAYG installments works in SMSF scenario. The other question comes, and very commonly asked, is if I have a property in my self-managed super fund and there are losses in that property because of depreciation or interest, or in other words, most commonly we say that the property is negatively geared. What happens to my losses? Am I eligible to claim those losses, or they are just gone? The answer to that one is they are not gone. Yes, the losses are eligible to claim, or it is negatively geared, but only in the hands of SMSF. You can't claim those losses in your personal tax return, but those losses can get offset against the SMSF income. Again, for an example, your employer contributed $10,000 to your super fund, and there was a tax payable of $1,500 on that $10,000 at a 15% tax rate. When the accountant is doing a tax return, they'll take that as an income, and then they also calculate the rental losses or all the rental income for your for your investment property. Now, if investment property made a loss of $2,000, that $2,000 loss will get offset against the $10,000 super contribution, which means SMSF will only pay tax on $8,000. So yes, you are actually using those losses against the SMSF income. So it is negatively geared and you can utilize that, but only in the hands of the SMSF. If for any reason there is no income there, or the SMSF overall position is negative, in that case, that loss is carried forward to next year to actually offset against the future income. So those losses are not lost anywhere, they are still there. It's just you can't claim in this financial year, you can claim in the future financial years. So that's really how the tax works in the SMSF environment. So if you get a bill from the ATO, it's because no tax was paid when actually your SMSF received the income or the employee contribution. So your SMSF has received the full income before tax, and the accountant calculates the tax, and you as a trustee of the SMSF pays that tax after the end of the financial year. If you need to know this into more detail, please feel free to contact our office, and we talk to you in our next episode.